Hi, welcome back to Simply Accounting. In today's video, we will be focusing on capital and the 4 transactions that affect capital as well. So in last week's video, we talked about capital, and I did a T account for you. And we talked about the beginning balance for capital is a credit on the credit side of the T account, and any increase to capital is going to be a credit, and any decrease to capital is going to be a debit. So today we're going to talk about the 4 transactions that affect capital. They are investments, withdrawals, revenue, and expenses. So the first one is investments, which are any assets that a proprietor gives to the business, but it's not used for the operation of the business. It's mostly used for when the proprietor first starts the business. So investment, the beginning balance of investment is going to be a credit. So any increase to investment will also be a credit, and any decrease to investment will be a debit. So this means that any investment is going to increase capital. So the next one is withdrawals. Now withdrawals are any assets that the proprietor wants to borrow from the business. So this would be a decrease to capital. So in withdrawals, the beginning balance is going to be on the debit side of the T account, and any increase to withdrawals would be a debit to withdrawals, and any decrease to withdrawals would be a credit. Okay, so the next one we're going to talk about is revenue. Now revenue is any cash that is earned from a sale of service or a product by the business. So this would be an increase to capital, because in the end, if your revenue is more than your expenses, then you have a net income, which increases capital. So for revenue, the beginning balance is going to be on the credit side of the T account, and any increase to revenue is also going to be a credit as well, and any decrease to revenue is going to be a debit. So there are 2 examples that I have. One is for sales, so that's if you own a business where you're selling any kind of products or anything. Your revenue would probably be sales revenue. So in this example, the beginning balance is going to be a credit. Any increase to sales revenue would also be a credit, and any decrease to sales revenue would be a debit. Now the next example is service revenue. So this is if you have a business where you do service only. So let's say like as a car wash or whatever, it'd be service. So for this one, the beginning balance is just the same. The beginning balance is going to be on the credit side of the T account, and the increase to service revenue would be a credit, and any decrease to service revenue is going to be a debit. So the last transaction that affects capital we're going to talk about is expenses. Now expenses is referred to as the cost of the business, so any cost that you have that will help you operate the business, that's what an expense is. So the expense is going to decrease capital because it's any cost that you have to pay for to run your business. So for expense, your beginning balance is going to be a debit, so because it's opposite of capital. Any increase to the expense would be a debit, and any decrease to an expense would be a credit. Now there's 2 examples that I have of an expense. The first one is utilities expense. So that's any electricity bills or water bills or anything that would fall under utilities. So the beginning balance for a utility is going to be on the debit side of the T account, and any increase to utilities expense would be a debit, and any decrease to utilities expense would be a credit. Now the last example I have is rent expense. So let's say you're doing your business out of a building, but you don't own it, so you have to make payments on whatever building you're in. So that would be under rent expense. So for rent expense, the beginning balance is going to be a debit on the debit side of the T account, and any increase to rent expense would be a debit, and any decrease to rent expense would be a credit. So now let's recap what we learned today. we reviewed capital again, and capital, the beginning balance is a credit, and any increase to capital is a credit, and any decrease to capital would be a debit. And then we learned the 4 transactions that affect capital. Investments are always going to increase the capital account because they have beginning balance is capital, and the increase to withdrawals is is credit balance. And then withdrawals are going to decrease capital because their beginning balance is on the debit side of the T account, and then the increase to withdrawals would be on the debit side of the T account as well. Now, revenue is going to always increase capital. They have the beginning balances on the credit side of the T account, just like capital, and any increase to revenue is also on the credit side of the T account, just like capital as well. And the last one is expense. Now, expense is going to lower capital because the beginning balance is on the debit side of the T account, and any increase to expense is on the debit side of the T account as well. Alright, so that concludes the lesson for today. I hope that you learned and understood everything that I taught you today. Hope to see you next week on Simply Accounting.